Welcome! Today we're diving into the invisible forces that literally control the money in our pockets. Think of the global economy as this massive, highly complex engine, but who's actually behind the wheel? Who decides when we need to accelerate for growth or slam on the brakes to avoid a total crash? Well, the answer lies with some incredibly powerful yet often misunderstood institutions, central banks. So get ready, because in this explainer, we're popping the hood on this machine to see exactly how it works using some fresh, data-driven research.
All right, let's quickly map out our journey. We'll start with the economic engine itself, then compare the systems of Brazil and the US. Check out their specific tools of control, dive into crisis and risk management, unpack some core strategic insights, and wrap up with some warnings and next steps.
Section 1. The Economic Engine, exploring the evolution of monetary control. You know, it's pretty common to think these massive financial institutions were born out of some perfectly planned blueprint. But honestly, the central banks we know today were actually born out of absolute chaos. Just look at this timeline. The story kicks off back in 1668 in Sweden. A guy named Johann Palmstruch founded a private bank and introduced Europe's very first paper money. Sounded like a genius idea, right? Well, he printed way more notes than he actually had metal in reserve. Predictably, the bank collapsed, people lost everything, and Palmstruch literally faced the death penalty. To stop that kind of disaster from ever happening again, the Swedish parliament stepped in and created the world's first central bank to put some order in the house. Fast forward, the Bank of England pops up in 1694 to finance a war. The U.S. Federal Reserve arrives in 1913 after a bunch of massive banking panics, and Brazil's central bank, the BCB, was established in 1964 to centralize a really fragmented system. So it was pure necessity and crisis that forged these institutions.
Moving on to Section 2, Brazil versus the United States, looking at the anatomy of two systems. Let's see how this evolution shaped the modern era by looking at the structural DNA of these two giants.
This perfectly illustrates the contrast. Brazil uses a highly centralized system. The big guidelines and inflation targets come from outside the BCB, set by the National Monetary Council, or CMN. Then, the COPOM board, which is just 9 members in Brasilia, executes the policy and sets the interest rates. The U.S., on the other hand, leans on a decentralized 12-district model. Why? Because historically, they really needed to balance the agricultural and industrial interests of Main Street with the financial power of Wall Street. Their decisions are made by the FOMC, which has 12 voting members. So we're looking at two completely different organizational philosophies here.
But the most striking difference is their actual purpose. In Brazil, especially formalized since 2021, the mandate is hierarchical. Price stability, meaning keeping inflation in check, is the absolute #1 goal, period. In the US, though, the Fed has a dual mandate. Maximum employment and price stability share the podium as equal priorities. And there's a huge, fascinating academic debate about this. Some argue that focusing strictly on prices, like Brazil, creates way more predictability. Others say the dual mandate, like the Fed's, gives a central bank the flexibility it needs to save jobs during a nasty recession. We're not picking sides here, but it's absolutely crucial to understand that the rules of the game completely change depending on where you are.
All right, Section 3, the tools of control. Accelerating and braking. Now that we understand how they're built, let's look at the actual pedals these central banks push to accelerate growth or stomp on to stop inflation. The absolute most crucial point here is the base interest rate, the Selic in Brazil or the Fed funds rate in the US. Adjusting this is the primary way central banks influence the real world. It affects literally everything, from your mortgage rate to massive corporate investments. If inflation is running too hot, they hike the rates. Borrowing gets expensive, people buy less, and prices cool down. That's the brake. But if the economy is stalling, they lower the rates, money gets cheap, and things speed up again.
But think about this for a second. What on earth happens when a central bank desperately needs to stimulate the economy, but they've already slammed the interest rate pedal all the way down to 0? How do you accelerate when you've run out of pedal?
Well, that's exactly where quantitative easing, or QE, comes into play. It sounds like intense financial jargon, but the core idea is pretty simple. When traditional rate cuts stop working, the central bank basically creates electronic reserves out of thin air to buy up long-term assets. By doing this, they're injecting massive amounts of liquidity right into the veins of the economy. It's basically a way to bypass the pedals entirely and just pump fuel directly into the engine.
And beyond just moving money around, communication itself is a massive tool. It's called forward guidance. It's basically the central bank telling the market what it plans to do in the future.
The Fed uses the famous dot plot to show where members think rates are heading, while Brazil's Copom uses their meeting minutes. By signaling their future moves, they anchor everybody's expectations right now, which helps stabilize the markets without even touching the actual rates yet. Pretty clever, right?
Which brings us to Section 4, Crisis and Risk Management. What happens when the engine overheats? Because driving this machine definitely comes with some serious risks.
Operating a central bank means dealing with massive uncertainties. First up, the Phillips curve trade-off. Historically, people thought there was a clear trade. To lower unemployment, you had to accept a bit more inflation and vice versa. Academics still fiercely debate if that even holds true today. Then you've got transmission lags. When a central bank changes rates today, it can take anywhere from 6 to 24 months to actually hit the real economy. Imagine steering a car, but the wheels only turn a mile down the road. There's also the severe risk of fiscal dominance, where a government is so deep in debt that if the central bank raises rates, they might bankrupt the state. And finally, market supervisors just never have perfect information on the risks commercial banks are secretly taking.
To see how they handled the unthinkable in reality, just look back at the 2020 pandemic shock. Both institutions basically emptied their entire ultimate crisis toolkits. The Fed slashed rates to essentially zero and committed to unlimited asset purchases. Meanwhile, Brazil dropped the Selic to a historical low of 2%, and their Congress even passed a constitutional amendment, the war budget, allowing the BCB to buy assets directly. Unprecedented measures for an unprecedented crisis.
Section 5, Insights and Strategy. Now we're getting into the really good stuff. Strategic insights drawn directly from our consolidated research analysis from May 2026.
$341 billion US dollars. That's a massive number. It represents Brazil's international reserves as of May 2026. But why does that matter? Well, while the US literally prints the global reserve currency, emerging economies like Brazil have to build up this gigantic financial armor. Holding all those billions is incredibly expensive, but it's the ultimate insurance policy. It guarantees to the world that the country can pay its bills and absorb massive external shocks.
And the core strategic takeaway from our May 2026 research is this: shielding monetary decisions from short-term political pressure is absolutely essential. Institutional autonomy, like Brazil's LC 179 from 2021, combined with macroprudential stress tests, are today's ultimate safeguards. Basically, ensuring the bank is independent and constantly testing for worst-case scenarios is the best way to protect an economy's long-term stability and your everyday purchasing power.
Finally, Section 6, Warnings and Next Steps. Our journey through the economic engine is almost over, but we really need to cover some essential guidelines first.
I'll be straight with you. We've explored some complex market scenarios and risks today, but this explainer is strictly for informational and educational purposes. Absolutely nothing we've discussed is investment, financial, legal, or tax advice. The economy is a wild ride, and past performance never guarantees future results. So please, always consult qualified professionals before making any big moves with your money. If you enjoyed popping the hood on the economy with us today, don't stop here. Stay ahead of the curve and subscribe to the Macroeconomic IA channel. Hit the links below and stay tuned for our latest data-driven insights, where we bridge macroeconomics, the frontiers of artificial intelligence, and cutting-edge technology. I want to leave you with one final, provocative thought. If central banks face a crisis tomorrow that none of their current tools can fix, what do you think the next great monetary innovation will be? Think about that. Thanks so much for joining me, and keep learning.